Let's face it, with housing costs and interest rates doing what they're doing, pretty much everyone is looking for a way out. We keep hearing about these radical new ideas, these creative fixes to a problem that feels, well, impossible. So we're going to dive in and try to separate what's brilliant from what's just a dead end. I mean, if you're sitting on a fantastic low mortgage rate, you're probably feeling completely locked in. And if you're trying to buy, affordability is just this massive wall. It's a squeeze from both sides, right? So today, we're going to break down some of the most talked about solutions and see what's real and what's just wishful thinking. Here's how we'll do it. We'll look at the big 50-year mortgage gamble, then the dream of taking your mortgage with you. After that, we'll uncover a forgotten solution that's already here. Then we'll shift gears to what really works. And finally, we'll get to the bottom line. All right, first up, the 50-year mortgage. I get it. The promise here is incredibly tempting. It sounds like a quick fix for the affordability crisis. But the real question is it a brilliant solution or a really dangerous trap? The logic is so simple, right? You just stretch the loan out over 50 years instead of the usual 30, and poof, your monthly payment drops. In a market where every single dollar counts, that sounds amazing. On paper, it seems like an easy win for affordability. So here's the crucial question. What are you actually trading for that lower monthly payment? Because believe me, there is always a trade-off. And in this case, it is a massive one that most people don't see in the initial sales pitch. And here it is, laid out plain and simple. Yes, you absolutely get that immediate relief in your monthly budget, but the cost over the life of the loan is just staggering. You are paying a huge, huge premium for that short-term benefit. And check this out. It really puts it in perspective. We're not talking about a little bit more interest. You could end up paying nearly double the total interest compared to a standard 30-year loan. Just think about that. That is a breathtaking amount of your money, your wealth, going straight to the lender over those extra 20 years. And beyond the cost to you, our entire mortgage system just isn't built for this. The U.S. market is a well-oiled machine, and it's built around the 30-year loan. Investors want it, insurers cover it, the whole system is based on it. A 50-year loan just throws a giant wrench in the works, which makes it super risky and expensive for lenders. In fact, this isn't even a new idea. We saw this play out when 40-year mortgages were tried, and they basically failed to get any real traction. Okay, let's switch gears to the next big idea, portable mortgages. Now, this is the absolute dream for anyone who has a 3% mortgage rate right now, isn't it? The ability to just pack up your great rate and take it with you to your next house. They do it in other countries, so why can't we do it here? So let's be super clear on what we're talking about here. A portable mortgage basically unties your loan from your property. You sell your house, you buy a new one, and that amazing interest rate you locked in years ago, it comes right along with you. It is the ultimate solution to feeling rate locked. But, and this is a huge but, the U.S. system is, well, it's a different beast. We rely on these long-term 30-year fixed-rate loans that get bundled together and sold to investors as securities. That's actually what helps keep our rates relatively low. In places like the UK or Canada, banks often just hold the loans themselves, which gives them the flexibility to allow for things like portability. Trying to make one of our securitized loans portable would create total chaos for the investors who own a piece of it. So after all that, you're probably thinking portability is a total non-starter here. But what if I told you that a version of it has been here the whole time, kind of hiding in plain sight? And that brings us to what might be the most practical idea of all, assumable loans. See, this isn't some new product we have to invent. It's an existing feature that is incredibly powerful, but almost nobody talks about it, and it's deeply misunderstood. And we're not talking about some niche, weird product either. We're talking about major government-backed loans, FHA loans, VA loans, USDA loans. All of these have an assumability clause built right in. That means a qualified buyer can literally take over the seller's existing loan, the rate, the terms, the whole thing. This quote from the source material just hits the nail on the head. The tool is already there. It's in the toolbox. The real problem is that almost nobody, buyers, sellers, even a lot of agents, knows it exists or has any idea how to use it. It's a failure of education, not a failure of the product. Now, let's be real, it's not a simple click of a button. First, there's that huge awareness gap. Then the new buyer still has to go through the full underwriting process to prove they can handle the payments. It takes a ton of coordination with the company that services the loan, and it definitely takes time. It is powerful, for sure, but it is not easy. So, if these big, flashy ideas have major drawbacks or are just misunderstood, what actually makes a difference for housing affordability? Well, the answer, it turns out, is a lot less exciting, but honestly, far more impactful. Real affordability wins come from tinkering with the gears of the system itself. We're talking about things like lowering the guarantee fees that Fannie Mae and Freddie Mac charge, pushing for more competition, and making small but really thoughtful pricing adjustments. These are not headline-grabbing new products, but they are the changes that can save borrowers real money without blowing up the whole system. So, after looking at all these potential fixes, we arrive at a pretty clear conclusion. When it comes to something as complex as housing affordability, there just is no single magical silver bullet. All right, let's bring it all together. The 50-year mortgage, it promises lower payments, but the reality is a crushing amount of long-term interest. The portable mortgage promises you can keep your rate, but it just clashes with the way the US market is built. And the assumable mortgage? It's a powerful solution that already exists, but it's held back by a complex process and a serious lack of awareness. This right here is really the core takeaway of this whole thing. Instead of searching for some revolutionary new product, we could get much better results by just getting smarter about the system we already have. Better education for all of us, better execution from lenders, and more disciplined pricing. That can deliver way more value than a radical and risky overhaul. And that really leaves us with this final crucial question to think about. In our search for affordability, is the answer really to tear down the entire structure and build something new from scratch? Or is the smarter path to fully understand, master, and optimize the powerful, if imperfect, system that we already have? It's a big question.